The Nasdaq just crashed over 4% in a single week. The government shutdown became the longest in US history. And while mega-cap tech got absolutely hammered, two stocks in our portfolio surged, one up 7%, another up 5%, while the market burned around them. This is the weekly market review for November 7th, 2025. And if you're wondering how to navigate this chaos, you're in exactly the right place. I'm Burke. If you are new here, I've spent nearly 40 years in markets, from trading and research, had a $250 million hedge fund, to 2 decades managing portfolios and advising clients. Now, through value-aligned investing, I help individuals and families become shareholders, owning great businesses directly, building wealth the right way, and never interrupting compounding. This week was a masterclass in why that philosophy matters. Because when the market panics, when shutdowns drag on, when the Fed sends mixed signals, the companies you own either prove their worth or they don't. Let's break down exactly what happened this week, company by company, sector by sector, and what it means for your money going forward. All right, here's the big picture for the week ending November 7th. US stocks took a beating. The S&P 500 fell 1.6%. The Nasdaq 100 absolutely crushed, down over 4%. But here's what's fascinating. This wasn't a broad market collapse. This was a targeted demolition of mega-cap tech stocks, while the rest of the market held surprisingly firm. Now, this is where it gets exciting. The S&P 500 fell 1.6%, right? But the equal-weighted S&P 500, which treats every stock the same, no mega-cap bias, only lost 0.2%. That's a 203 basis point gap. What does that tell us? The average stock in the S&P 500 barely budged. This entire week's carnage was concentrated in a handful of mega-cap tech names: Microsoft, Nvidia, Salesforce, AMD. These juggernauts got hammered, while mid-cap and smaller companies held their ground. That's actually a sign of healthy market structure, not deterioration. Let's look at the scoreboard. S&P 500 down 1.6%, but still up 15.6% year to date. Russell 2000 small caps down 2% for the week. And the Nasdaq 100 again absolutely pummeled, down 4%, though still holding on to a 21.7% year to date gain. The key insight: technology stocks are still the strongest performers this year, despite this week's bloodbath. That tells you this is profit-taking and valuation reassessment, not a fundamental collapse in the sector's long-term prospects. So where did the money go? Into defensive names. Energy led the charge, up 1.6% for the week. Why? 2 reasons: geopolitical supply concerns from ongoing conflicts, and optimism about the new China trade deal. Healthcare was next, up 1.3%. And we'll talk about Eli Lilly in a minute, because that stock was an absolute monster this week. Real estate, financials, utilities, consumer staples, all green, all defensive. All the places investors run when they're nervous about growth. On the flip side, technology got destroyed, down 4.2%. Communication services, consumer discretionary, all red. This is classic risk-off rotation, and it happened fast. Here's the full breakdown. Energy at the top. Healthcare is right behind it. And look at this. Technology is still the best performer year to date at 24.5% despite this week's carnage. That's resilience over time, even when you have weeks like this. The chart tells the story. When volatility spikes, quality defensive sectors protect capital while growth takes the hit. Drilling deeper into industries, software was the worst performer, down 5.2%. Enterprise spending guidance disappointed, and SaaS multiples compressed hard. Semiconductors fell 4.1%, despite an incredible year-to-date run of plus 43.8%. But here's the standout. Metals and mining, up 65% year-to-date. Copper demand for electrification, defense spending, that's real, fundamental demand driving those stocks higher. This isn't speculation. This is supply and demand economics at work. All right, let's talk about the week's star, Eli Lilly, up 7.1% in a week where everything else was bleeding. Why? Because they absolutely crushed earnings. Revenue up 54% year over year. Adjusted earnings per share, $7.02, way above the $5.89 estimate. Mounjaro for diabetes, Zepbound for obesity, these GLP-1 drugs are printing money. And management raised full-year guidance while announcing positive phase 3 results for their oral GLP-1. This is what happens when a company doesn't just meet expectations, they obliterate them. The stock is up nearly 20% year to date, and the pipeline momentum is accelerating. When you own quality businesses with real earnings growth and genuine innovation, they perform even when the market is in chaos. Next up, Permian Resources. This energy stock was up 5.6% for the week, and for good reason. They reported third quarter earnings that beat expectations. Adjusted EPS of 37 cents versus the 30-cent consensus. But here's what really matters. Number one, they hit a record $469 million in adjusted free cash flow. Number two, production growth up 18.2% year over year. And number three, a 4.8% dividend yield. And a fortress balance sheet with only 0.8 times leverage. They just got their first investment grade rating from Fitch. Analysts have a $21 price target on this stock. That's 65% upside from here. This is what operational excellence looks like. Growing production, generating cash, paying dividends, and strengthening the balance sheet all at the same time. Energy isn't dead. Quality energy companies are thriving. Now, let's talk about AMD, which was down 8.8% this week. But here's the thing. They reported record third quarter revenue of $9.25 billion, up 36% year over year, and guided Q4 revenue above estimates. So why did the stock fall? Profit taking. Pure and simple. AMD is up 93% year to date. Investors are locking in gains amid broader tech sector pressure and concerns about elevated AI valuations. But here's the key. The company's fundamentals are rock solid. November 11th, that's Tuesday, AMD holds its Financial Analyst Day. They're expected to unveil the MI500 series GPU roadmap and detail AI partnerships with OpenAI, Oracle, and others. That event is a critical catalyst. If they deliver a compelling vision for their AI infrastructure business, this stock could snap right back. This is what volatility looks like when you own growth leaders. Short-term pain, long-term opportunity. All right, we can't ignore the elephant in the room, the government shutdown. As of this weekend, it's now the longest in U.S. history. 1.4 million federal workers without paychecks. Key economic data releases suspended. And Goldman Sachs estimates a 6-week shutdown could shave 1.15 percentage points off Q4 GDP growth. Consumer confidence just hit its lowest level since June 2022. The ADP report showed only 42,000 private sector jobs added in October, way below normal. If this shutdown extends past Thanksgiving, we can see a full-blown market correction. Meanwhile, quantitative tightening ends on December 1st, which could provide some market support. Policy uncertainty at its finest. Welcome to late 2025, another moment when the experts pretend to know how their actions affect a $30 trillion economy. And don't get me started about the dual mandate, the so-called we have to maximize employment and at the same time minimize inflation. I've said it before, you cannot maximize along two dimensions at the same time, even with constraints. So our Congress has given the Federal Reserve's mere mortals a job that they can't do. And so around all these policy terms, we always get these periods of great uncertainty. We don't know what's going to happen even if they lower rates, and we don't know what's going to happen out of Washington. So does that matter for your financial plans? No, of course not. We invest in shares of great companies. Great companies are managing through policy uncertainty. We hold and we look for corrections to buy more. Meanwhile, quantitative tightening ends on December 1st, which could provide some market support. Policy uncertainty at its finest. Geopolitically, two significant developments. First, the US-China trade deal announced after the South Korea summit, effective November 10th. Tariff reductions, agricultural commitments, suspension of retaliatory tariffs. Markets gave it a lukewarm response. Second, ongoing conflicts. Russia-Ukraine war disrupting energy supplies. Israeli-Palestinian conflict continuing. Houthi attacks in the Red Sea are creating uncertainty over trade routes and driving energy premium pricing. None of this is going away anytime soon. So how did your VAP portfolio perform? For the week, we declined 1.5% net of fees. The S&P 500 fell 1.6%. Year to date, we're up 16% net of fees versus the S&P's 15.6%. But here's what matters more than any performance number. The individual companies we owned, Eli Lilly, Permian Resources, Installed Building Products, they performed because of fundamental business strength, not because we were trying to beat a benchmark. We don't manage to benchmark. We own businesses we believe in, and this week, several of them proved exactly why we own them. Let's name names. Eli Lilly, up 7.1% for the week, up nearly 20% year to date. Permian Resources, up 5.6% this week. These are quality companies executing at the highest level. On the flip side, AMD down 8.8%, but still up 93% year to date. That's profit taking, not failure. Novo Nordisk down 7.6%, losing market share to Lilly in the GLP-1 space. This is why company-level analysis matters. Individual business quality determines results, not macro trends. So what's next? Here's what we're watching. 1. Government shutdown resolution, essential for data releases and confidence stabilization. 2. AMD Analyst Day on November 11th. If they deliver a strong AI roadmap and partnership details, it could reignite semiconductor momentum. 3. Key earnings this week. Occidental Petroleum, Tyson Foods on Monday, Cisco and TransDigm on Wednesday, Applied Materials and Disney on Thursday. 4. Leadership rotation. Can technology earnings justify current multiples? If not, the rotation into reasonably valued cyclicals and quality defensive names will intensify. Bull case. Shutdown resolves quickly. Semiconductor outlooks impress. Healthcare momentum continues. Bear case. Shutdown extends past Thanksgiving. AI spending concerns deepen. Tech valuation compression accelerates. We're positioned for volatility, focused on quality businesses and watching these catalysts closely. Listen, this was a wild week. Mega cap tech got crushed. The government shutdown hit a record. The Fed is sending mixed signals. But quality companies like Eli Lilly and Permian Resources showed exactly why fundamental analysis and business quality matter more than market noise. If you want to understand why Eli Lilly is absolutely dominating the GLP-1 market and what it means for the future of obesity and diabetes treatment, and whether Novo Nordisk can fight back, I just published an analysis you need to see. Click the link below where I break down the entire competitive landscape, the pipeline, and what investors need to know. Thanks for watching. I'm David Berkowitz with Value Aligned Partners. See you at the next one.